Hello my financial friends, it's your friend Jack here, and today we're going to be talking about a strategy of investing that anyone can use. It's a very simple strategy that you probably have heard of or you might not have heard of before to basically mitigate your risk and take that risk level down of your investments to a bare minimum, especially over a bear market or a really stagnant market that is not very active. So essentially what this strategy is called dollar cost averaging. Now you may have heard of this before, but if you haven't, it basically allows an average investor to pretty passively enter the market, at the same time every single month and not have to worry too much about whether they're in a bad time to buy or a good time to buy, because they're going to buy no matter the market release date. They're going to continue to buy every month at around the same time with the same amount of investment. And this investment doesn't have to be a large amount, but basically instead of putting $10,000 into an investment at once or a stock at once, you split that $10,000 over 10 months, once a month of $1,000, and now you have 10 different entry points to the stock price, and your position is really spread out a lot further. You're not just stretched thin if the market were to crash or go up, because you have been putting this $1,000 over time into the investment and not all at once. You aren't just in one position. Now I'm going to go ahead and grab a chart and show you guys an example on how this can work, especially for long-term investments. So we're going to look at this chart here, but something to keep in mind is that dollar cost averaging basically assumes that the market is always going to go back up or return to above the shares you bought. Now, this works heavily in the favor of declining stock prices that are down for a long period of time, but also come back up because the investor continues to put money in regardless of the share price, meaning on average, in this example, they are getting each share for $8.85 because they put their investment over a period of, many months, rather than just all at once putting $6,000 in at $10 per share. They spread their investment over time, and the price eventually did come back up to the original amount, but because they did their investment over time, they did it at a good point where the markets were going down and up a little bit, but mostly down from the original point which they bought their first 100 shares, as seen here in the diagram. They actually came out with a better price per stock on average, and this isn't always going to be the case. However, it is a lot better than assuming that, kind of putting a emotional attachment to what you think is going to happen. This is kind of a way to take emotion out of your investments and just invest the same amount every single month. They got a different amount of shares every single month that they're investing, but they ended up with a better average price. And this isn't always going to be the case, but this is a much more passive way to invest, and it kind of takes away the emotion side of things like I just mentioned, so you don't have to worry as much if your one position is a bad position or not. Now you have 6 positions in this example with your $6,000, not just one position with $6,000. So if you're new to investing and you're not sure how to invest, don't put all your money into one stock or one couple of stocks even all at once. Divide your stocks or your investment, make a payment plan for your investment, and you can do dollar cost averaging pretty simply. And also you don't have to take that big hit out of your bank account all at once because you're investing it over time, which is also a nice thing to put your mind at ease. And this is going to be a way more passive way you can set up your investments, especially if you're new. It's going to be 100% easier to do. And even if your original position is lower than your next positions, and it's the opposite of this graph, your share price average is going to be, not that much different, and the risk you're taking on each investment is less than if you were to put it all in one position. So even if it were potentially better to put all your money in at once, over the long run, you don't know what's going to happen. So by doing this, you can take some of that risk away of having all your stocks in one position. And yes, you do have a little bit less to gain by taking less risk, but it's just easier and less risky, especially if you're long-term investing and you're holding these shares for a long period of time. Then this is a great way to get into investing in the stock market as a beginner, and it's pretty passive as well. Alright, that's the whole video. I hope you guys enjoyed and found this useful in some way or another. If you guys did, please smash the like button. And it's been your friend Jack. With all that being said, keep learning, keep earning. I'll see you guys in the next freaking video tomorrow. Peace out.